Hey everyone, this is Ben. Thanks for checking in, and welcome to It's All in the Reflexes, our I think second recorded video. Just as a brief video update of the trend. A reminder that we're going to do a live call tomorrow night. That's open to everybody who's a subscriber. We'll go through some of the market timing tools that I talked about in the last newsletter, and then have some Q&A. We can look at any individual companies or cryptos or things like that we'd like to live during the call. But you really want to have an opportunity to chat about what we're seeing in the broader market, economics, and near-term trend. But a few things to go over tonight. So today is probably today was the best day in the market in several days. We've of course had a frustrating few days of gradual drawdowns, and we've had a lot of pressure from U.S. dollar trending upwards. And as we can see in the table below, commodities still remain pretty strong in the short term and in the intermediate time frame, and starting to pick up in the longer term trend. That's very late cycle type of behavior, but it can move back and forth. So what we'll be looking to see over these next few days and a couple of weeks is we'd like to see the U.S. dollar index cool off. Commodities, probably do need to cool off a little bit, but they're going to follow this extended move up that we've seen in gold. So we'll probably see commodities run pretty well for a little while, unless we get a gradual shift downward in the market's expectations for interest rates. And that's really what's driving a lot of this. When there's expectation of interest rates going up or remaining high, that puts a lot of upward pressure. It's a strong tailwind to the U.S. dollar, pushes down the value of treasuries, and then that cascades into equities. So it goes in this sequence where bonds and treasuries top first, and then equities. Gold starts to pick up in anticipation of that, and then eventually commodities start to pick up, and that's our signal that there could be longer term risk. But these things can happen in short time frames, and so it's not necessarily doom and gloom. We're seeing the near term trends, or the trends as evaluated by moving averages, pick up favorably. That's a good sign, and our sectors are fairly positive across the board, and we're seeing the VIX and the VIX of the VIX fall, which is going to be positive for equities as well. And then with our up-down oscillator, you can see that this is for the first time in a couple of months, we're starting to approach a high level for consecutive days with upward movement. So that's all good news. And the good news comes to us, with this shift in CPI, and so we've got year-over-year CPI, still coming in a little bit high, but it's been relatively flat, right? But the month-over-month core CPI came in a little bit lower than forecast, and I think the market's probably looking for more good news than exists here. I don't, we've gone over this before, but PPI is important. CPI is important. These are good measures of inflation, but this is not what the Fed looks at. The Fed looks at the consumer price, the CPE, and specifically the CPE PI, and several measures of that. So that's the measure that's on the bottom here, and so personal consumption and expenditures is a cumulative figure, and so that's going to build on all of the prior inflation that we've experienced, and that's why the Fed watches that so closely. So while the market's excited that we've had a little bit of improvement in the CPI, which still has to update in the data for TradingView, that's not what the Fed's going to be looking at for monetary policy, and they've been pretty clear about that for a while. So the market's just pleased with the good news. But what we can see here is that the relationship to look for is the producer price index is going to have the greatest influence on the consumer price index. So when producer prices, the expense to produce goods goes down, that benefits consumers, and it happens pretty quickly. As soon as the producer prices change favorably or unfavorably, they're going to make adjustments, forecast those adjustments into their expectations, and they're going to pass that along to consumers, and that's what results in this big spike up in inflation. As soon as they see this, so we've got a rate of change indicator down here on the bottom. As soon as they see this rate of change go up, they respond and they increase prices, and that results in a big leap in price increase for consumers. And even after the rate of change cools, prices continue to increase for a long time before we see the CPI measure actually start to come down. And then what that does for the PCE is PCE goes up, in the same experience. It's low in the same time frame as the other two, but its rate of change is starting to cool at the same time that the PPI is. So the PPI is probably the closer measure of what we should expect to materialize in the figure that is most important to the Fed for setting rate policy. And you can see we've got this, this distance in between a 9-period moving average and the PCE figure. And when you've got that gap, that is consistent with us having a high rate of change, and so it's the slope is increasing. Now that that's cooling off a little bit, that's favorable for monetary policy. But our last reading, was still an upward movement in its rate of change. And so this is what we really want to be cognizant of. If the Fed is not seeing progress on PCE, rates are going to stay where they are for a while. Which, and we've talked about this in the newsletter, is favorable for equities. If prices remain high during an easing cycle, the more gradual that this is, the better that this is for investors and traders. The market will react to it every time it gets news, but we need to keep in mind that this is, what's logical, what makes sense, and try to anticipate where we can. We've gone over this in every one of the articles. It remains like the number one on my dashboard for risk management, and this is Andrew Thrasher's, based on Andrew Thrasher's paper. He calls it the 5% canary, and so what we're looking for is when we see the drawdown from a new 52-week high, if we see a 5% drawdown within the first 15 trading days of a new 52-week high, that's an elevated risk. And we've still got that elevated risk on the indicator showing up for the Dow. And then once that's been triggered, it's confirmed if within 42 trading days we cross below the 200-day moving average. And so we're going to be tracking this alert from the Dow all the way out until the third week of February. But we're seeing positive progress in the other indices, and so that's good. We don't have an alert active to monitor for the S&P or the NASDAQ, and all of these are less than 5% away from their recent 52-week high. So that's good news, and that tells us this has preceded some of the worst drawdowns in market history. And that's why this is so important to me. I want to make sure that if we see this alert, that we can take the appropriate action, protect the wealth that we've worked so hard to build. So while we've had some nice progress these last couple of days, and we're seeing the S&P pick back up to like 5950, 5960. That's good news, but I don't think we're out of the woods yet for drawdown. This was the one that really had me concerned a couple of weeks ago when it triggered. So right at the end of the year, nobody, I don't know of anybody that's looking at put-call ratio in this fashion, but this is another indication that sentiment has changed and is adverse to the near-term outlook. So this is looking at the relationship between puts and calls. It's also looking at the VIX and the Williams VIX fix, which is an approximation of the VIX. So VIX uses like options contracts to measure volatility, and what the VIX fix does is for instruments that don't have the same options contracts to measure with, it approximates it with a formula. And so sometimes you'll see things in the options and futures markets that are different than what's happening in the spot equity market. And the VIX fix is kind of an interesting way to compare the two. You're seeing the same volatility in the price movement as you're seeing in the option space. And so it just kind of blends multiple volatility and risk indicators into one, including the average true range of the price. So if we're trading in a really big range versus a tight range, that implies some risk in volatility as well. So combining all of those things, when we see a downside breakout of this Bollinger Band from this measure, it's typically going to be followed by a drawdown in the market. There's a few false positives out there. You've got a couple like in 2021 where we don't see anything happen after the signal. And that's why we're using this follow line. And this is more of a Forex tool. So it's much more responsive to equities than we would normally prefer. This is also used as like a Bollinger Band formula, but with a tighter standard deviation. So when you've got foreign exchange assets that change in price, those will have maybe like a tighter range of movement. And so this is going to be more sensitive to price than we would normally like for equities, but in conjunction with, or in combination with this put call, volatility weighted put call measure, it's really giving us a great signal, because it's telling us, you've got to change, and you can see there's false positives, as well elsewhere, but you've got this change, and you've got a shift in sentiment at the same time. And when you see them both happen at once, that 100% of the time going back, it leads to a drawdown. And they're not extreme drawdowns. So it's not doing a good job of telling us, and this is a great one up here, right? It only goes down a couple percent within the span that the signal is active. And then we have a much larger drawdown in 2021 that it's not reacting to, because the options market and volatility space is already kind of normalized to the change in trend. So you're not getting a new signal, and you've still got a very large drawdown coming. So this is telling us that there's a drawdown active in the market, but it's not, it's not going to be the 5% drawdown indicator and protect us from a crash. But until this has turned positive, so what I'm going to look to see is the put call line go back to blue and approach its 20-day moving average cloud. And I'm going to look for the follow line to turn positive. And that's going to be our signal that it's safe for new buying and to take on a little bit more risk. So while that's active, that's going to be a primary for me. And then a new study, and I want to keep this brief, so I'll just go through this one for this recording and try to keep ourselves to under 15, 20 minutes. But this is called the Fabian market timing model, and this is a fairly old method, but what this is doing is pretty simple. It's looking at 39-week moving average, and it's looking at the 39 moving average, 39-week moving average for the S&P, the Dow, and the Dow Utility Index. And when all three of those indexes fall below their 39-week moving average, it's risk off. And when all three come back above, it's risk on. So it's a very, very slow moving indicator. And the nice thing about it is it's got a very high win rate. And it's because it's keeping us from being whipsaw. So the problem with trend following is called whipsaw, where you're getting a lot of false positives that you're responding to, and you'll exit and then come back in at a higher price when you confirm that the trend is high, or the trend is still favorable. So so this insulates us from some of that, and is a better tool for protecting long-term funds versus short-term trades. The prior tool with the put call ratio, that's a great way for us to protect funds that we use for short-term trades, and to say, while this thing is active, I'm not going to open any new trades or use short-term techniques, and I may take a little profit on bounces. Whereas this one is saying, there's a real problem here, and we should probably take greater precautions. So the blue line is the 39-week mark, and you can see we've got a lot of positive trend data. The only one that's signaling below the 39-week moving average is the utility index, and we would, the traditional way that this signal is supposed to be used is that we would need to see all three come below for us to exit. Now, it's still a little bit slow moving for me. So what I've done is I've taken each of these indexes and created a cycle composite. So it's using the 39-week moving average, essentially a 20-week moving average, and then a 10-week moving average. It's using a weighting, blending those together to create a cycle, and then with that we can turn that into a strategy, and the strategy could be adjusted to say, we're going to open long when the averages of these indexes go above zero, and we're going to close the long. And in this case, I'm looking at when the individual cycles all roll below zero. And so this is a long only strategy. I do not like this one for shorting the market. It's got very limited success in shorting. Actually, we can update the table and see, when we're using these signals for shorting, it's almost break even, and you can see it's because you're shorting late and then having to close the short. So using it as a long only signal, and even then you still get a little bit of whipsaw, but you're getting a signal that tells you there's danger, and that's good. So the average return is 19%. I'm using just this as a signal. Win rate is almost 80%, and profit factor is 2.9, which means you essentially get a return of $3 for every $1 that we lose. And then the average loss is still around 16%. I think that's because we're coming in, it's a slow signal, so it's still pulling us out a little bit late, and that's why we use more than one method to help us with market timing. But that's the Fabian market timing model. I'll once we do the live call and things, I'll set this up as a shared table or shared chart as well, like we did with the 5% drawdown chart, in case anybody wants to bookmark it and follow along. But this is going to tell us, what the 39-week moving average is, how many weeks we've been above the 39-week moving average, how far above the 39-week moving average we are, whether the 10-week moving average is, whether we're above or below the 10-week moving average, what the slope of the 10-week moving average is, and then this 39-week moving average alert, which we can see we only have for utilities, whether the individual cycle is above or below zero. It looks like we'll get an alert for the Dow. We should actually have an alert for the Dow, so I'll have to look at the code for that. And then the composite cycle, which is this white line, if that's below zero, it'll tell us that as well. So we can monitor it with a table, with alerts, and we can model the conditions and look for the best outcome for a strategy for us. But so that's the market timing model. And in summary of this one, it's saying that it's still, while we've had several days of frustration from the equity market, this is still not a risk-off event for us. It's just a precaution, which aligns to our expectation for year two of a presidential cycle and for seasonality for the month of January. So I feel like this is still a very favorable investment market for me, and everybody makes their their own call risk-wise. But I feel like this is not a risk-off environment, but I'm also not seeing anything that says it's risk-on yet. Still in a monitoring phase. But hope this is helpful, and look forward to any questions that you guys have when we touch base tomorrow night. And but feel free to reach out anytime if you do have questions or suggestions. Thanks.